Hello, everyone, and welcome back to the Velocity channel where we are your bridge to financial freedom. Listen, I got an announcement to make today. We want to show you how to pay off all of these loans using the money that you already have within your checking, within your line of credit, within your savings. And you know what? We know that we don't want to really use the IRA, but we're going to go ahead and throw that in the mix as well, just to show you how you can get more cash flow back to do more things with in your life. Now, before we get started with all this, I want to show you something, all right? I want to show you that if you can hit that bell, if you can press a like, if you could share this all over the world so that people can know how powerful velocity banking is and then implement it in their country. Can you imagine you being part of a solution for millions of others? It is possible. Now, before we get to this, I do want to let you know that, listen, Financial Peace University, I graduated, folks. I graduated from Financial Peace University. I just want to let you know I have no hard feelings to the man that runs that. All right, listen, we believe in education. That's why we are such advocates of educating, especially financial education. And I'm going to be digging into that a little bit more as we go on in our other videos. But listen, if you don't want to write down all this stuff, don't worry, there's an automated solution, right? There's automated velocity banking. We also have that channel and solutions for that as well. So let's get into this, shall we? We've got $12,000 in our line of credit, right? Checking account, $1,000 in it. Savings account, $2,000, and our IRA has $10,000 in it. Now, mortgage, $200K at 6%. Listen, I keep using that number because it's easy math, all right? It doesn't matter if your mortgage is higher or a little bit lower. The principles that I'm going to install here work across the board. Just like I can jump up and come down in America, guess what? If I go to Africa, guess what? I can jump up and come down there. If I go to Asia, guess what? I jump up and I come down there. Why? Because the same law applies everywhere. Okay, so it doesn't matter the number, all right? It does matter the principle. It does matter the law. We're going to get into that. 20K is the hat with eyes right here, the car loan at 18%. And then we have, I know you think that's a bank, but that's, well, close to a bank. It's student loans, 20K at 3%. Now, let's get into it. How are we supposed to pay all of this? Normally, what you do is you pay the minimum monthly payment on all of them, don't you? So your priority is Minmo, right? Minmo here, Minmo there, and Minmo there. And you don't even think about chunking, right? Perhaps if you got a bonus and you schedule it out to, okay, let me go ahead and chunk the principal here, chunk the principal there. But did you know that you could actually chunk the principal in more than just one way, in more than just 1 month, right? You can actually chunk the principal on multiple months if you know how to do it. Let me show you what I'm talking about. If we take our line of credit, $12,000, okay? And I know you wouldn't do this, right? But if you use the whole thing to go ahead and chunk the mortgage, all right? So what are we left with when we do that? We're left with $200,000 minus $12,000. Man, I did not calculate that beforehand, so let me do my best to calculate it right now as I stall. What is that, 188? Am I right there? 188,000? Yeah, I think that's right, okay? So if you reduce it down to 188,000, now what is that 6% chewing on? It's now chewing on the 188,000 versus the 200,000. Now, CJ, wait a minute, you got another debt, right? That line of credit is now used up. Yes, but when you get paid, where does your paycheck go? Where does it go? Okay, your line of credit. Is that an option? Yes, it is. Let's go ahead and put that $5,000 to the line of credit. Remember, your expenses, okay, are going to be less than That's right. You want your expenses to be less than your income, not more than your income, not the same as your income, but less than. So let's say you have $3,000 expenses. That income is $5,000. How much is left in your line? $2,000. So what's paying your line of credit? $2,000. Okay. But CJ, I didn't have to write a check towards my line of credit. I didn't have to pay it. I just used it as my new checking account and just let the overage stay in there. I just let the $2,000 stay in there. Exactly. So as that $2,000 stays in there, all right, how long are you going to pay off that? 6 months, right? About 6 months because of the interest that is charged on it, all right? Listen, as you continue on, right, to pay this mortgage, you're going to pay the minimum payment, which is probably going to be around $1,200 each month. What happens as you're building this back up? What happens when it's back at $12,000? What happens? Well, you got to use it again, don't you? That's what it's there for. These are soldiers, okay? Think of them as Marines. Think of them as people that are deployable, okay? And they are working for you. You can't just leave it in the line, okay? All jacked and nowhere to go. You got to deploy them so that they can fight for you. So how are you going to deploy these troops? You're going to do it again, okay? You're going to do it again to the mortgage. But let's say this. Let's say the cash flow index says, listen, you don't have to pay the mortgage off. You don't have to use this as a priority. You can actually place all of these, depending on their minimum monthly payment, right? You can place them on a cash flow index indicator, which I'm showing you right now, so please pay attention. I'm showing you right now how to calculate whether you need to chunk the principal on the mortgage, on the car loan, or on the student loan first, okay? This is how you do it. Loan balance, these are the loan balances, divided by the minimum monthly payment. On a scale of 0 to 100, okay? You're going to say 0 to 50, well, that's the danger zone. From 51 to 99, that is the caution zone. But if you got a mortgage, right, and it is 100 and above on any of your loans, okay, that 100 and above loan is going to be the freedom zone loan, and you don't really have to place that as the priority. I'm not saying you don't ever have to pay it off. I'm saying you don't have to play that as high, put that as high of a priority as the other ones. Because the closer you get to 0, that's an inefficient loan. See, 0 is an inefficient loan, okay, anywhere between here. Okay, these are more efficient loans. Okay, so you want to pay these off as quick as possible. Why? Because it's sucking your cash flow relative to what they've given you, right? Look at this, $20,000. You got to pay that back, right? They didn't just give it to you. Is that correct? The $20,000, the $200,000. Okay, you have all this. All right, the great. You got the mortgage. You got the car. You got the student loan. You can attend classes, but we need to know how to pay this off. Buy the line of credit, that's one way. Let's go ahead and see which line of credit, right, needs to be deployed next. Okay, is it to the mortgage? You may say no because of the cash flow indicator. It's 100 and above. Mortgages are usually 100 and above. All right, so now you're going to look at, okay, well, is it the car loan or is it the bank loan that I need to go by first? Do I need to pay the car loan off or the bank loan or the student loan? And I know what you're thinking. You're thinking, CJ, duh, you pay the highest interest one off first. Yeah, that's what it looks like, huh? Believe me. Run it through the calculator first. You've got to hear me on this. Run your decisions through the calculator first. Do not go off what it looks like. You'll mess around and get drained, all right? Don't go off what it looks like. Make your decisions, your financial decisions, by the numbers. And if you need help with that, man, just let us know, all right? And so that's how it's done, guys. Lines of credit, right? You can do the same thing with the checking account. You can do the same thing with the savings account. Don't be discouraged just because you maybe not have 12,000, right? Maybe you got 1,000 in the checking. Maybe you got 2,000 in the checking. Hit that chunking principle, right? Listen, 198,000 at 6% is still better than 200,000 at 6%. All right? You got to put that in the comments below. All right? So when you're chunking, remember what you're doing. You're getting rid of that principal so that the bank cannot charge you that interest that is sucking your cash flow. That interest is coming back to you. So you can think of it like this. As you chunk, I know it may seem like this over here is getting less and less. So you got 0 over here and 0 over here. But as you're deploying those troops, you're gaining more in interest. Those that don't understand interest, pay it. And those that do, earn it. All right? I want you to earn interest, folks. Man, get with me. See if we can help you out as well. You know, we got the Automated Velocity channel as well. We want to help you out in any way we can to eliminate those loans and build that wealth. God bless you, and we'll talk to you soon.